Business ethics has become a big business in its own right. It's grown from a fringe issue that some small-time alternative CEOs might mention in passing, to a corporate staple that has its own course in 90% of the business schools in America. Major companies now mix in ethical initiatives with their earnings reports, and there are even dedicated research centers focused on studying how companies can solve all of the world's problems with some combination of acronyms. DEI, CSR, ESG, TBL, whatever your favorite is, they are all guidelines for how the world's most powerful companies can look out for something other than their own free cash flow. So then, why the fuck is this the second worst idea in business history?
Every day that my dad came to work, he came home and he was happy and he was fulfilled.
If it is about serving as many people as possible, then the right place is born.
We are looking at how we are training and giving leadership development and making coaching available from the very best to every one of our distributors.
Corporate social responsibility, or ethical business, whatever you want to call it, it should be an easy idea to sell. You probably don't like it when companies pollute your home, take your money with deceptive practices, or lobby your government to spend your tax money on their bailouts. But operating ethically in business often comes at the expense of acting profitably, and company leadership, who answers exclusively to their shareholders, will be forced into picking profits over ethics. Corporate social responsibility, therefore, is all about showing company managers, their boards, and their shareholders that there is a way that everybody can win, and that ethics and profit don't have to be at odds with one another. The message of the double bottom line is catching on. It now has some big-name supporters like Klaus Schwab, the chairman of the World Economic Forum, who literally wrote a book on stakeholder capitalism. The World Economic Forum is a controversial organization best known for an annual meeting where the world's rich and powerful meet up in the Swiss Alps to talk about how the world ought to be run. Stakeholder capitalism has been one of their big initiatives, and in theory, it doesn't actually sound like a bad idea. It basically says that instead of companies looking after their shareholders, they should look after all of their stakeholders, which in addition to their investors also includes their employees, their suppliers, customers, and society at large. The idea of getting companies to be on their best behavior is not just lip service either. There is now some serious money behind it. According to Bloomberg, investment funds that specifically invest in ethical companies now hold over $7 trillion in assets under management. But there are three reasons why corporate social responsibility, or whatever you want to call it, is the second worst business idea in history. It's bad for employees, it's bad for shareholders, and worst of all, it's bad for everybody else. The first reason is that it puts all of the power into all of the wrong hands. If you put a tiger in a petting zoo for a kid's third birthday party, it's not the tiger's fault that there is no fourth birthday. It's the fault of the adults that should have known to put the proper restrictions in place to make sure that the tiger couldn't feast on little Timmy. This does not dismiss or forgive the bad actions of companies. If you are subscribed to our other channel, you will know that history is littered with companies committing actual crimes against humanity in the name of maximizing profit. But it should not be their job to decide for themselves what is right or wrong. And least of all, should it be up to them to enforce ethical standards. That is the job of real lawmakers, real courts, and real authorities. Initiatives like ESG investing, industry standard corporate governance controls, and yes, stakeholder capitalism have been used to lobby against official government regulation that could actually hold bad actors accountable. Companies have said that instead of the real authorities with some teeth regulating them, they will regulate themselves, and they pinky promise that this will be a win-win for everybody. The tiger has promised that it's gone vegetarian. And there are no need for those electric fences that the zookeepers were thinking of installing anymore. Companies like Shell, BP, Exxon, Lockheed Martin, Northrop Grumman, Boeing, Monsanto, Nestle, and worst of all, EA, all have pages and publications dedicated to talking about their ethical standards, corporate diversity, and environmental controls. Researchers at Columbia University and the London School of Economics compared the ESG records of US companies and ESG funds to non-ESG companies. They found that the companies in the ESG portfolios actually had worse compliance records for both labor and environmental rules. Their ethical efforts were mostly performative to get regulators to look the other way. Even when these companies do get caught doing stuff that's not only unethical but downright illegal, the image of corporate ethics is still valuable. A report by The Economist found that firms that had been convicted of bribery in the US under the Foreign Corrupt Practices Act received more lenient fines if they had been seen to be actively engaging in comprehensive CSR practices. Instead of being a major shakeup to their operations, companies took the threat of regulation and turned it into a marketing campaign and an investment opportunity. According to a market report by PwC, ESG funds have been some of the fastest growing investment tools in history. Bloomberg Intelligence estimates that environmental, social, and governance-derived investments will be worth $40 trillion by 2030 and represent a quarter of all financial assets under management. That's not bad for an initiative designed to dissuade overzealous regulators. It's understandable that investors would like their money going towards companies that are, at the very least, trying to do the right thing. But unfortunately, not many people really understand how these investments work, or how they could actually be making these problems a lot worse. So it's time to learn how money works to find out why corporate ethics is the second worst idea in business history. This week's lesson was sponsored by Odoo, the all-encompassing business management software that brings together a full suite of integrated apps to streamline every aspect of your business operations. From sales and CRM to inventory management and accounting, Odoo simplifies complex business processes by integrating them into one user-friendly platform. Odoo gives you the power to manage your sales pipeline with a few clicks, automate lead scoring, and even predict the next best action to take with your leads and customers. With Odoo, efficiency isn't just a buzzword, it's a built-in feature, especially in manufacturing and business planning. The platform's MRP capabilities allow for seamless production planning, scheduling, and real-time inventory tracking, ensuring your business runs like a well-oiled machine. Customization and ease of use are at the heart of Odoo's design. Whether you're in need of CRM, sales, inventory, project management, or even just creating your own app with Odoo Studio, the platform molds to your business requirements. Select only the apps you need, making it as lean or comprehensive as you wish. And the best part? You can experience the simplicity and power of Odoo firsthand without any commitment. Getting started is risk-free with a 14-day free trial, no credit card required. And you can use any single app free forever. Click the link in the description or request a demo today to see how Odoo can transform the way you do business. Swapping out real regulations with real consequences for self-governance would be okay if it worked. But ESG and other brands of corporate ethics have shown too often to be worse than literally doing nothing at all. If you invest into an ESG fund, what you are really doing is buying a slice of lots of companies that a fund maker like Vanguard, BlackRock, or a smaller investment manager has decided meets their ESG or corporate ethics criteria. The idea is that by directing your investment money towards these companies, they can grow faster and outcompete companies that are behaving unethically or damaging the environment. The problem is that a lot of the most popular funds don't really work like this at all. A report from the Harvard Business Review found that some of the most popular funds with a corporate ethics or environmental thesis actually had a larger weighting of fossil fuel companies than just a broad market index. BlackRock's U.S. Carbon Readiness Transition Exchange Traded Fund sounds like an investment into a pool of companies improving battery technology, building renewable power stations, or making electric vehicles. Right? Wrong. What this fund actually does is invest into companies that BlackRock believes will be the best positioned to benefit from the transition to a low-carbon economy. Oil companies are heavily weighted in the fund because they will benefit from more expensive energy prices and government subsidies during any transition. So this supposedly ethical investment opportunity is not so much encouraging a transition as much as it's trying to profit from it while letting the investment manager that put it together charge a higher fee than they would be able to charge for a regular passive index fund. Other funds are slightly less misleading towards their well-intentioned investors and will try to invest into companies doing good, but even that has major problems. There are three methods for building these ethical funds: the active, the inclusion, and the exclusion method. An active fund will have a team of analysts picking which companies they believe will do well based on an investment criteria, in this case, good ethical credentials. Actively managed funds charge higher fees because they have to cover the large salaries of market researchers who decide what stocks to buy and what stocks to sell at what time. After accounting for these fees, most actively managed funds underperform the market, so they are becoming less popular with investors. The inclusion method requires a little bit less effort from the fund manager. These funds work by filling an index with companies that are in ethical industries or doing things that people consider ethical behavior, like having a benchmark of diversity on their board or in senior management positions. You may not personally consider criteria like the diversity of board members worth investing in, but there are thousands of different funds, all with different ethical criteria. The exclusion method is the most passive of all. It will just take an existing fund and kick out particularly bad companies. The problem with all of these methods is that it can be very hard to build a diverse portfolio of ethical companies, so they lower their standards or pick the least bad option. Exxon and Shell are both oil and gas companies, but maybe Shell built a few more windmills or purchased more carbon credits, so they would be included in a fund that wanted to be ethical but wants exposure to energy more. Even that wouldn't be so bad if these investments still did well, but they don't. Some investors don't really care about how ethical the companies they invest in are. They just think that ESG investing will still outperform the market as a general trend towards more accountable business takes place. The market for these funds is still new, and maybe there is a long-term benefit of how these ethical companies operate, But unfortunately, ethically constructed funds have consistently underperformed the market. But this all ignores the biggest, dumbest issue of all with corporate ethics. Your idea of what is ethical may be very different from mine, and that's okay. Where some people might see environmental destruction, you might see the most affordable fuel source that could heat people's homes and power industries that put food on the table for millions of people. Creating a hard and fast template for what counts as ethical and then rewarding companies that pretend to adhere to it hasn't been good for investors, it hasn't been good for society, but it hasn't even been good for the companies either. Performative ethical measures are often unaffordable to small businesses. If investors and customers are exclusively seeking out businesses that can afford to hire teams to ensure their quality for ethical recognition, then smaller businesses without those resources will be less competitive with larger companies that are normally less ethical in reality anyway. Bill Gurley, a venture capitalist who invests into early startups for a living, has said that regulations overwhelmingly favor incumbent businesses because they are the only ones that can afford to make sure they are compliant, and that applies to self-regulation as well. Gurley is a venture capitalist, so he is financially motivated to make it easier for small businesses to grow. But that doesn't mean he's wrong. Even the large companies that can mask over their ruthless profit motive with ads about how sustainable they are, it's still an expense that doesn't really achieve much, but will ultimately be passed along to their customers. The Nobel laureate economist Milton Friedman argued that this was basically an invisible tax placed on customers and shareholders who may not even personally agree with the brand ethics that companies are self-governing with. Even in cases where corporate social responsibility is not just a marketing exercise, the personal ethics of the corporate executives that are making the framework are likely to be very different than the stakeholders they are working for. A wealthy executive might, for example, prioritize environmental initiatives over increasing worker compensation because to them, that seems like a more important issue. The real solution to all of this is to let regulators regulate. Businesses seek profit, and for the people to decide what businesses should and should not be doing. We will be writing an article about the exact process companies use to hide behind the smokescreen of self-imposed ethics. That will be available on our totally free email newsletter in the video description. If you are wondering how this is still only the second worst business idea in history, go and watch our video on maximizing shareholder value to keep on learning how money works.